Good afternoon, everyone. This hearing will be the first in a series of hearings for the committee to examine the recent market volatility involving GameStop and other stocks. I want to know how each of the witnesses here today and the companies they represent contributed to the historic trading events in January. This recent market volatility has put a national spotlight on institutional practices by Wall Street firms and prompted discussion about the evolving role of technology and social media in our markets. These events have illuminated potential conflicts of interest and the predatory ways that certain funds operate, and they have demonstrated the enormous potential power of social media in our markets. They have also raised issues involving gamification of trading, potential harm to retail investors, and the business models of apps with retail investors as their users. All of this is why we have witnesses from many of the key players here to testify today, including witnesses representing Wall Street firms Melvin Capital and Citadel, social media company Reddit, trading app Robinhood, as well as one of the retail investors involved. In subsequent hearings, we will hear from regulators and other experts regarding these events, including why Dodd-Frank rulemakings related to short-selling disclosures were never implemented. Many Americans feel that the system is stacked against them, and no matter what, Wall Street always wins. In this instance, many retail investors appeared motivated by a desire to beat Wall Street at its own game, and given the losses that many retail investors have sustained as a result of volatility in the system, there are many whose beliefs that the system is rigged against them has been reinforced. Others have noted that there are winners and there are losers in every trade in our financial markets. Our role as a Financial Services Committee is to ensure fairness in our financial markets and system, robust protections for investors, and accountability for Wall Street. Today, this liquidity problem had real consequences for your customers, but I wonder if they were all that surprised. Between December 2019 and December 2020, Robinhood customers experienced monetary losses due to system outages. Customer accounts were reportedly compromised. The firm repeatedly failed to testify its best execution obligations, and it misled its customers regarding its revenue sources. It seems retail investors often get a bad deal at Robinhood. Mr. Tlaib, also, while you testified today that, quote, Robinhood's customers benefit greatly from payment for order flow, quote unquote, in December 2020, the SEC charged Robinhood for not disclosing that it was getting paid to send customer trades to Citadel Securities and other market makers, and for not seeking the best terms for its customers' orders. Robinhood provided such inferior trade prices, it cost your customers over $34 million. Citadel's role in this event also raises significant questions for policymakers. Citadel Securities pays Robinhood tens of millions of dollars to process trades by Robinhood's customers. This relationship gives Citadel Enterprise key non-public information as to direction and volume of trades by retail investors. Your firm makes use of private exchanges called dark pools and other off-exchange trading to trade large sizes without moving the market against you. In fact, at some point last month, 50% of all trades occurred in dark pools or via OTC off-exchange trades. Your business strategy is designed intentionally to undermine market transparency and skim profits from companies and other investors. One problem, though, Mr. Griffin, is that we don't really know how central your firm has become to the capital markets.
The chairwoman's ways of characterizing this hearing was who wins and who loses. And I've spent a bunch of time in the last couple of days looking at the various players here. I'm pretty convinced that the wholesalers, Citadel is one of the winners. They make a lot of money. They're the casino in this story, and the casino tends to win over time. Robinhood has a valuation of $5.6 billion and makes a lot of money from the casino. So who loses? And I want to spend some time talking about the person who usually loses, and that's the retail investor. And while I have supported for many years the democratization of finance, as we say, it's not just in Washington, D.C., but on Wall Street. The retail investor is known as dumb money. And there are any number of structures that are set up to take advantage of the retail investor. And I think it's worth looking at that because as much as we're celebrating Mr. Gill here, we're not talking very much about Mr. Salvador Vergara, who was featured in a Wall Street Journal story, who took out a $20,000 personal loan through Robinhood, invested it in GameStop, only to see the value of his position go down 80%. So Mr. Vergara is out $16,000 he doesn't have that he owes to somebody else. And as much as I support the democratization of finance, we need to be thoughtful about this. So, Mr. Tennant,
the stated mission of Robinhood is the democratization of finance, but I worry that the real world impact of Robinhood is the democratization of financial addiction. You know, Robinhood has gaming features that seem to manipulate retail traders into making rash and reckless and potentially ruinous investments. We all know the tragic story of Alexander Kearns. According to a memo from the Financial Services Committee, there's one feature in particular that encourages retail investors to tap on the Robinhood app up to 1,000 times a day in order to improve their position on the wait list for Robinhood highly coveted cash management feature. Do you share my concern that a retail trader tapping on a Robinhood app 1,000 times a day is a sign of addiction?
Congressman, that particular feature that you're discussing was to get access to our debit card plus high yield savings product, which is one of the many features targeting passive investors that we've rolled out over the past.
Mr. Tlaib, 1,000 times a day? You are encouraging your customers to tap on an app 1,000 times a day? That to me is a sign of addiction, and it worries me that you fail to see it in the same light.
Congressman, we didn't encourage anyone to tap on anything. To get access to the debit card, people were placed on a wait list, and we wanted to give our customers delightful features so that they know that we're listening to them and that we care about them. And this is just one example of how we add great features that customers love to our products.
Look, addictive trading might be bad for your customers, but it's good for Robinhood. Addictive trading means more trading, and more trading means more money for Robinhood. There's a sense in which Robinhood monetizes addiction. You make money from the quantity rather than the quality of trading.
You know, as many of my colleagues have also pointed out, Robinhood generates much of its revenue from the payment for order flow arrangements with market makers like Citadel, as well as Two Sigma and Virtue. And in 2016, the SEC highlighted ways that the payment for order flow created a, quote, potential conflict of interest with a broker's duty of best execution. And then one of the ideas that the commission floated in 2016 for addressing these conflicts of interest was to require that brokers pass on the proceeds of a payment for order flow. Now, earlier, one of my colleagues, Representative San Nicolas, said that Robinhood owes its customers a lot more than an apology, and I happen to agree with him. I believe that the decisions made by you and this company have harmed your customers. Mr. Tlaib, would you be willing to commit today to voluntarily pass on the proceeds of the payment for order flow to Robinhood customers?
Congresswoman, I appreciate that question. When the statement you referred to was made, I believe 2015 or 2016, it was before Robinhood forced the entire industry to drop commissions and replicate our business model, which made payment.
So is that I should take that as a no, you're not willing to pass on the proceeds of payment for order flow to your customers?
When the other brokers dropped.
I'm just talking about today, right now.
Payment for order flow, Congresswoman, allows for commission-free trading. In the context of trading commissions, it's a much larger source of revenue in the past than payment.
Mr. Tlaib, I apologize, and I don't want to be rude. I just have limited time. But if removing the revenues that you make from a payment for order flow would cause the removal of free commissions, doesn't that mean that trading on Robinhood isn't actually free to begin with? Because you're just hiding the cost in terms of potentially poor execution or the cost of lost rebates to your customers.
Forgive me, let me interrupt you there. You admitted to making mistakes. Specifically, what mistakes did you make?
I admit to always improving, and certainly we're not going to be public. We're not going to be perfect, and we want to improve and make sure that we don't make the same mistakes twice.
Democratization of finance is a good and noble goal, but for democracy to work, consumers need transparency and high quality information, and not only about fees, but about order execution quality. Your customers actually don't care directly about who you subcontract order execution to or any payment for order flow, but they need a simple way to compare the execution quality between your app and competing apps or other accounts. So, Mr. Tenna, since Robinhood's mission is to democratize finance for all, I ask, what are the mechanisms that you would accept and support to provide transparent order execution quality statistics so that your customers can engage in a clean apples to apples comparison between other brokers, between your app and other people's apps in terms of the total cost of trading?
Also, back in December of 2020, we released a public page on our website that provided detail about the execution quality, including price improvement that our customers received. And we're proud to announce in 2020, our customers received in aggregate over $1 billion of price improvement on their executions.
Right, but that's not a comparison to your competitors.
Here's my point. Let me go to it quickly. The market maker Citadel traded over-the-counter stocks for its own accounts in 2012, from 2012 to 2014, while simultaneously delaying client orders for the same shares. And it was fine for this. Citadel has been naughty for some time. 2014, Citadel faced $800,000 in penalties. 2017, $22.6 million. 2018, $3.5 million. 2020, $97 million. And another 2020 of $700,000. This seems like a lot of money. It is for me, more than $124 million. But over the same period of time, Citadel had revenues generated in the amount of $13.2 billion. It seems to me that the punishment for these improper trades and improper actions, because it wasn't just trading, Citadel also did some other things that were not proper. They misled clients. Seems that the punishment is so small given the amount of revenue generated over the same period of time. It seems that Citadel has at least an opportunity to build into its cost of doing business paying penalties. And that concerns me. It concerns me that the punishment doesn't seem to deter Citadel. It concerns me because I know of circumstances where in persons who are not in the market, they do things that are much less harmful, and they can possibly go to jail.
So on the specifics, when people sign up, they get a scratch-off ticket to see what they get. Confetti falls every time they place an order. They get push notifications. They're encouraged to trade. If a friend signs up, they get a free stock, on and on. Why have you added specific gaming design elements to look like gambling to your app? That encourages more frequent trading.
Congresswoman, as I mentioned earlier, we want to give people what they want in a responsible, accessible way. We don't believe in gamification. We know investing is serious, and that's why most of our customers are buy and hold. A very small percentage of our customers utilize margin.
Well,
And-
I appreciate that, but you know, folks like my nephew actually aren't your customers. They're your product. Your customer's sitting right next to you, Mr. Griffin with Citadel. So when you don't pay as much for index fund or Apple or anything like that, your app to me shows me that you're really just trying to encourage more trades, which puts more money in your pocket, not helping people build equity through smarter investing. So I would
June 2020, Alex Kearns, who was 20 years old at the time, from Naperville, Illinois, killed himself, largely thanks to a bug in the Robinhood system. The bug was that he turned on the app, said he owed $730,000 that he did not have because of options positions that he thought canceled out but didn't appear to. He called the helpline. The helpline, of course, was not manned, as we've discussed. He sent several panicked emails, 3 to be precise, did not receive a response. Ultimately, there was a response from the email saying that, in fact, his positions were covered, but by that point, it was too late because he had taken his own life. This is a gentleman who was 20 years old. Under Illinois law, he was not allowed to buy a beer, but he was allowed to take on $730,000 in positions and exposure that he did not have the liquidity to cover. Now, your mission, Mr. Tennant, is to democratize finance, but the history of financial regulation is to protect people like Alex Kearns from the system. As the old joke goes, if you're playing poker and you can't figure out who the fish is at the table, you should leave the table because you're probably the fish. And there is an innate tension in your business model between democratizing finance, which is a noble calling, and being a conduit to feed fish to sharks. Okay, so do you route options trades to anyone who you do not have a payment for order flow agreement with?
Currently, we have Congressman uniform payment for order flow arrangements with all of our market makers, so they would all be under the same arrangements.
Okay, so how do you ensure that you're getting best pricing if every single firm, you're ruling out anybody who is not paying you for the privilege to trade?
Congressman, we believe having uniform payment for order flow arrangements with all market makers ensures structurally that there is no conflict of interest because it prevents payment for order flow from being an input in decision-making for where to route orders.
Okay, I'm almost out of time, but there is an innate conflict in your model. Let's imagine right now that we are today's version of Alex Kearns. I'm nervous. I think I've got an exposure, and I call your helpline now. Let's call and let's listen in the time we have remaining to what I'm going to hear on the other end of the phone.
Thanks for calling Robinhood. Please visit us at robinhood.com or on our app for support. If you have an urgent trading need, please make sure to include details of your order when reaching out. Thanks and have a great day.
As we all know, the wealthiest 10% own 84% of all stocks. In fact, 50% of American families own no stock at all. I say this to emphasize that to many of my residents, the stock market is simply a casino for the rich whose gambling hurts pension and retirement funds. And when you all screw up, the people end up paying the tab through losses or bailouts. So I want to talk about the high frequency trading. We know about half of all stock trading in the US is done by computers. They analyze market activity and instantly complete trades at a profit. So this high frequency trading allows Wall Street traders to get ahead of transactions done by pension accounts and retirement funds. So in effect, some estimates indicate that as a result of the high frequency trading though, pension and retirement accounts pay nearly $5 billion in a tax. This means that Wall Street firms like yours engaging in high frequency trades are actually making money at the expense of my residents' retirement funds. So one way to ensure that this enormous wealth generated on Wall Street actually reaches the real economy, y'all, you know, what's happening right here in our communities and in my district, is to enact and look at proposals like a financial transaction tax. And let me tell you, according to recent polling, the majority of Americans, all of you need to hear this, and it's going to grow, the majority of Americans support taxing Wall Street transactions. Taxing them at just 0.1% would actually raise $800 billion over 10 years, which could fund programs like helping my district expand healthcare, nutrition, public education. I heard my friend from Texas, who we all are praying all the families will be taken care of. Talk about access to water and electricity. But guess what? Right now in my community, it's so poor that I have families melting snow so they can flush their toilets because they have no access to water. So this tax to me would discourage risky and high frequency trading, unfair high frequency trading.
SEC rules require that people get the best execution, but I've recently learned that there's best execution and enhanced pricing. So if you get an order from Fidelity and you get an order from Robinhood and you're paying for the Robinhood order flow, is the Robinhood customer getting as good a price as the Fidelity customer?
As I was trying to explain, because the Robinhood order comes from a community of traders who tend to trade in smaller size.
That isn't my question, sir. You're evading my question by making up other questions. Let me repeat. 2 identical orders come in. Same stock, same quantity. One's from Robinhood, one's from Fidelity. What happens?
So as I said earlier, size of the order is only one factor.
You are doing a great job of wasting my time. If you're going to filibuster, you should run for the Senate. Everyone else I've talked to in this industry says when you pay for order flow, you get when your broker is being paid for order flow, you get a worse execution.
I'd say that's a lot. It seems to me that your company is systemically important to our financial system. Would you agree with that?
I believe that we play an important role in the U.S. capital markets. I believe that our hedge fund would not be in the category of systemically important. With $30-some billion of equity, it is simply not at the scale or magnitude of a JP Morgan, a Bank of America, a Wells Fargo. And
yes, you're not one of the big guys that we have visit us frequently, at least a couple of times a year. Is Citadel Securities, you were fined recently by FINRA for trading ahead of customer orders in the past? Is that what I heard from a couple of questioners earlier today?
I believe this was brought up earlier, that we paid a fine to FINRA for trading ahead in the OTC market back in the, let's say, roughly 2012 through 2014. It was due to a systems failure. Now, we have no tolerance internally for having made such a mistake. We have, of course, have taken actions to rectify such mistake.
Okay, but that did occur.
That did occur.